the economy is far weaker than is generally understood. I realize that the active marketplaces on recession predictions have fallen way off. Um, I would bet against that. I think the recession risks are better than 50-50. And I believe that that's being confirmed now increasingly by the hard data.
Mhm.
So the economy is facing increasing and is now exhibiting increasing signs of pain. And there's no real stimulus coming in to offset it, at least for the near term, as far as I can see.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. It's an especially confusing time for investors. On one hand, the U.S. economy is showing signs of slowing, with a negative growth rate for Q1 GDP and mounting evidence that many corporations and consumer households are feeling the pinch of higher borrowing costs. On the other hand, FOMO is returning to the stock market as corporate earnings look solid, tariff tensions ease somewhat, and optimism over the longer-term impact that the Trump administration's business-friendly policies may have on the economy grows. So, what's more warranted here, optimism or pessimism? For perspective, we've got the great fortune today to sit down with one of the greatest living economists, Dr. Lacy Hunt, former senior economist for the Federal Reserve Bank of Dallas and current executive vice president of Hoisington Investment Management Company. Lacy, thanks so much for joining us today.
Glad to be with you, Adam. Always a pleasure.
Thank you, Lacy. Well, look, the pleasure is most definitely mine, but it's wonderful to see you. You look great, my friend. There's a lot to talk about today, which we already sort of addressed here before we turned on the camera, so let's just jump straight into it. Before I get to some of the specific news that I want your reaction to, Lacy, just at a high level, what's your current assessment of the economy and the financial markets?
It's far weaker. The economy is far weaker than is generally understood. I realize that the active marketplaces on recession predictions have fallen way off. Um, I would bet against that. I think the recession risks are better than 50-50. And I believe that that's being confirmed now increasingly by the hard data, and that the economy has a very difficult walk here ahead of it.
Okay, so it's interesting. So U.S. Treasury Secretary Scott Bessent, whenever he's sort of probed by the media, he says, "Well, look, the soft data has been bad, but he says the hard data doesn't look so bad, and I'm gonna stick with the hard data until anything changes." You're beginning to see cracks in the hard data, it sounds like.
I think so, and the revised national income and product accounts um, for the first quarter show deterioration, significant deterioration in my aspect. One of the things that economists like to look for is to compare what's happening to GDP and GDI, gross domestic product, and income.
Mm-hmm.
And so we now have the first estimate for GDI, and it declined 0.2% in the first quarter. And to me, it's more meaningful when they're both lined up than when they diverge. When they diverge, one has to try to figure out which is more reliable. But in this case, we don't. Um, Another very critical aspect of the first quarter is that the Bureau of Economic Analysis is showing that consumer expenditures were far weaker in the first quarter than originally reported. They grew only 1.2%. That's a downward revision of 0.6 of a percentage point. Huge downward revision. And in my view, it's not surprising because I think the consumer is under pressure, and the consumer loan rates are really not affordable and they're not reasonable. In addition, the consumer, we've seen the serious delinquency rates on credit cards jump back to where they were in 2011. Same true for automobile loans. We're now beginning to see a rise in mortgage delinquency rates. And with the student loans now due, a massive increase in student loan delinquencies. And so the consumer is under pressure. Another very important aspect of the first quarter is that there was a massive inventory surge. Now, the inventory surge was part of the buy in advance. So when President Trump was president-elect and he announced he's going to raise tariffs, there was a great buy in advance. And the impact of the buy in advance had its tentacles all over domestic and international data for November, December, and even here into the early part of May. So firms went out and they bought imported goods, brought them into the country, caused the trade deficit to balloon. It'll be reversed. But the side aspect of that is that there was a huge buildup in inventories. Inventories are contributed 2.6 percentage points to GDP growth. So in the first quarter, a big jump in inventories at a time when consumer spending growth was coming down. And the indications that I'm seeing based on limited returns so far in May is that if the consumer is still exhibiting this same kind of difficulty. And firms now have to move this inventory. They don't want to hold it. And that's going to present a problem. And the third aspect of the numbers today, and this is going to really surprise people, and those that are invested in the stock market should pay a little bit of attention to what I have to say. The stock market, of course, focuses on the S&P earnings that come from the companies. And as you know, the critical thing here is whether the reported numbers beat or lose to the street. Right. So we say beat the street game. So if you whittle down the earnings estimates and to a very low level, and the final numbers come in better, you beat the street and you have a great positive reaction. But the numbers from the Bureau of Economic Analysis for corporate profits, in my view, are more reliable because what they're doing is they're relying on the income tax payments to the IRS. And so if you jigger with those numbers and you understate them, you can lower your taxes, but you can also be subject to civil and criminal penalties. Mm-hmm. And so the BEA is saying that there was a very significant fall in profits in the first quarter. More than $100 billion, 3.6%, not annualized.
Interesting.
And in fact, the drop in earnings reduced more than half the gain that we saw in the fourth quarter. And that's not surprising because a lot of the domestic demand was really centered in very few sectors. Consumer spending was weaker, not only in the service sector, but in goods. Non-residential fixed investment declined in the first quarter. Residential fixed investment declined in the first quarter. The strength was really in two categories of equipment spending. One was that there was a massive, well, basically 9 months of automobile planes were delivered in the first quarter rather than the normal 3-month delivery because there'd been a series of strikes. And so the aircraft deliveries were very robust. And then, of course, there's this phenomenal rise in the artificial intelligence and the data centers. A lot of the critical, advanced, leading indicator sectors contracted. And that goes hand in hand with deterioration. The certain components of the economy, very few did well, but it was not enough to offset the weakness elsewhere, and corporate profits dropped. Um, and so the underpinnings of the economy, and this is very hard data, are flashing, certainly flashing yellow and possibly even red. Another indication is that we're continuing to witness this upward creep um, in both the initial unemployment claims and more significantly in the continuing unemployment claims. Now, it is true that the continuing the new claims remain relatively depressed in terms of historical comparison, but they're gradually edging upward. More importantly, the continuing claims here in late May were the highest since November of 2021. And so while the layoffs haven't jumped significantly, people are not being recalled. And I think that is a significant development, and it goes hand in hand with the job openings data, which have continued to decline.
Mm-hmm.
So the economy is facing increasing and is now exhibiting increasing signs of pain, and there's no real stimulus coming in to offset it, at least for the near term, as far as I can see.
Okay, wow. So there's a lot going on there. Let's see. I very much appreciate you highlighting that part about the drop in corporate profits. That hadn't really hit my radar as clearly as you've outlined it. So I'm going to be looking at that closely going forward.
Yeah, the share of corporate profits of total GDP also fell quite sharply in the first quarter.
All right. So let me ask you this. So a couple of things. First off, you've shown signs that a lot of players are weakening, but a lot of the quote unquote growth that we saw in Q1, of course, the Q1 GDP was negative overall, but
People are poo-pooing it because there was when imports surge, that's a deduction from GDP.
right. They're saying it's a special
So
case
let's
because we had
just
all this front running.
disregard it. However, you need to look at the income side of the national income and product accounts, and over time they have to be equal. They're equivalent mathematical terms and conceptual terms. And GDI also declined in the first quarter. And one of the reasons it declined is because corporate profits were a clunker.
Right. So let me ask on corporate profits then. So if we had all this front running, meaning we have all this inventory that's now sitting there on shelves, that's going to have to be moved, and we have a weakening consumer, does that make you even a little more pessimistic for corporate profits going forward because they're probably going to have to offer some discounts to get this stuff moved off the shelves now because they've got a lot of it and the consumer's not buying as much?
Yeah, absolutely. They're going to have to discount to move it. And what it tells me is that I have felt for some time that monetary policy is too restrictive. And as you know, I like to look at the four-year moving average of detrended money supply. I prefer to take out the money market mutual funds and the currency to get a better cyclical measure. That's continuing to decline. And so monetary policy, I think, is too restrictive. And so monetary policy is not moving to alleviate these weakening signs, which increases the odds that they're going to gain momentum. Now, some people will say, well, we have the big, beautiful bill. We have the quote tax cut. I've studied that bill pretty closely, and I'm not a great one for doing this sort of analysis. But this big, big, beautiful bill is not a tax cut in any significant way. It's a tax extension.
Right.
Yes, there are some tax cuts. There's the elimination of taxes on tips and overtime, but that's a very small thing. There's a credit for some low-income recipients of Social Security, but they didn't actually reduce the Social Security tax rates. There are some corporate benefits that extend in later. Um, and so, to my way of thinking, the big, beautiful bill is really not going to have much of an impact if it passes the Senate in the current form, in terms of the budget deficit as a percent of GDP for 2025 and 2026. And it's quite possible, and again, here we don't know because the tariffs have been ruled unconstitutional by the trade court. We don't know whether that will be reversed or not. Also, I might add that um, the Trump administration has additional legislation that they can use. They could have used the Section 120 of the 1974 Act, in which the only criteria is that the country be running a trade surplus against us, and they could have imposed the 15% tariff.
And
And
that's
there
almost
was
every
no,
country.
yeah, I mean you can't go above 15, and you have to roll it over every 150 days. But if they, in fact, the trade court mentioned that they had better language, a better legislation that they could have used. But I mean, I don't know the political process, but it seems to me that my sort of initial reaction for someone that's not a lawyer and not a great student of political affairs, this really doesn't change uh, the fact of the matter of tariffs. Um, I calculate that tariffs were we had a 3% tariff prior to all of the actions by the current administration, and I was assuming that after everything was done, we would probably have a 12% tariff. By the way, a 12% tariff would take us back to where we were in 1941, which was the year before I was born, and that's a long time ago. And uh, I don't see where um, that really changes that much. And if you, I calculate that if you had a 12% tariff versus three, um, the revenues are about 300 billion a year, a little bit more than 25 billion a month. And if you combine the tariff impact with the budget actions, and keep in mind the Tariff Act actions by the administration are not picked up by the CBO calculations because the Congress is not the source of those revenues. So if you pick those revenues up, um, basically whatever mild net boost to GDP that might be in the big beautiful bill is erased by the tariffs. There's no impact, as far as I can tell, of any substance. Maybe I'm off a little bit, um, but there's no major substance. I mean, stimulus coming from the big beautiful bill.
Okay, so let me ask you about this, Lacy. And there was a big question I was going to ask you before we got to the administration's policies, but let's finish this conversation and go back to the big question I have about you, which is about money supply, which is a big thing you look at. Um, but let me make sure I understand this on the bill. Uh, having not combed through the whole thing, I've certainly heard the critics say that that as currently written, it will likely increase the deficit, the annual deficit for several years, and will add a couple trillion of new debt to the national debt pretty quickly. Is that your read as well? I hear you
No,
saying
not
it's not.
not for 25 and 26. The debt is added in the longer term. And moreover, keep in mind, it's just a tax extension. And so it's not like the tax rates are going down. They're
Right, right.
staying at
We're,
the
we're simply
same level.
keeping what we have in place. Yes.
Yeah, because if you didn't extend the 2017 Act, the tax rates would go back to where they were in 2016, and the economy couldn't stomach that.
Okay.
So the Congress basically has to roll over the or extend the current tax rates. But there is simply not that much stimulus, and in terms of the deficit after the bill, compared with before, I see it basically neutral in terms of the deficit as a percent of GDP.
As a percent of GDP.
As,
Okay.
as a
But it's still elevated, all right? I mean,
It's
we're
still
still at
evident.
6%
It's
or
still
whatever, right?
elevated if they're able to bring in $300 billion a year of revenue from the tariffs, which is who knows, um, then you actually take the deficit down from 6% of GDP to 5%, which is too excessive because the debt trajectory is not changed. And as you know, Adam, I feel the debt is a restraint on growth.
Right.
It's a problem, and so um, the bill is really not that important. It's just an extension of tax rates, and it improves the deficit a little bit, but doesn't address the massive debt overhang, which is going to remain a tremendous obstacle. And as a consequence of that, as the as debt matures, it's going to have to be rolled over at a higher interest expense.
Right.
The interest expense on the federal debt is going to continue to rise, become more and more important. That's a dead weight loss.
Right. So the drag on economic growth that you think the current government debt is only going to get worse, is what you're saying.
Doesn't change it. Doesn't change it. It would be far too risky to allow the tax rates to rise back to the 2016 level.
Right.
Either the consumer or the corporate sector, in my view, strongly that is out of the question. It,
So
that
so
that would precipitate a serious recession.
yeah. So let
Um,
me ask you this question, which I've been asking people recently, so I want to get your input on it. Um, it's you can make the argument it's hard to see the big beautiful bill not passing in some shape or form for that alone, right? Meaning it's almost like having a gun to a hostage's head. It's like, look, do you want these tax rates to go back up to where they were? Because as you said, the economy just can't take it, right?
that's exactly, and so because the debts problem is so big, the House did what they could to take care of some of the campaign promises, which really weren't that expensive. The eliminate of taxation on tips is not a big item. I, my sort of feeling is it's no more than 50 billion a year, maybe a little bit more, a little bit less. Um, and when you've got such a huge deficit as we have, that's really a rounding error.
Yeah.
Um,
But
and,
it's delivering on a populist promise you make. It's probably a pretty easy political give for him. But to your point, it's not going to drive the needle much economically.
no, and uh, my recommendation would be that there had to be much greater restraint on federal spending. Now there is some because they tightened up the Medicaid requirements and the supplemental nutrition requirements where there were clear evidences of fraud, uh, and tightened up the likelihood, as I understand it, of what payments are going to those that were not eligible for Medicaid and so forth. Things that are certainly important to do if we're a society of laws. Um, and then, of course, there were significant cutbacks in green energy, which were part of the Inflation Reduction Act.
Hmm.
Um, Things that had also been promised during the campaign. And so the bill, in terms of the impact on the deficit of a percent of GDP is very small. Um, and it's also, we have to understand that it's under the ceteris paribus assumption that economic growth continue at 2%. If you have a recession, which I think is a better than 50-50 risk, then the deficit is going to go up, 2% of GDP. So you wouldn't stay at 5, you go to 7, you never even see the improvement. So, and that's why I personally have thought that monetary policy is too restrictive. And the Fed thinking that they're in a good place, they're not in a good place. And
Okay.
and the economy needs the support of the Federal Reserve, and it's not forthcoming.
So you agree, it sounds like, with President Trump then when he's calling Fed Chair Jerome Powell too late, Powell, that you think the Fed is acting too late here. Um,
Well, I
so
think the Federal Reserve has consistently acted too late over its entire history.
I know, I
They,
know.
the
Not a
Fed
surprise
has
to you.
constantly over eased and over tightened, but right now monetary policy is far too restrictive, and there needs to be a reversal.
Okay, let me remind viewers too that you are a senior economist to the Federal Reserve Bank of Dallas, so you know of which you speak.
Well, I also is one of my fields of study, but I've been interested for a long time in it, and I did some pretty significant econometric work a long time ago.
Yeah, right. So the fact that you who have been, involved and such a, an academic student of Federal Reserve policy makes a criticism like that, it should carry a lot more weight than the average pundit because of your closeness and
I
your experience.
appreciate the accolade, but I don't, I don't
Uh,
think it does.
That's because you're an extremely humble gentleman, Lacy. So let me ask you this, and then I'll get back to that big question I teased. So Lacy, beyond just this bill, right? If we lump everything together, tariffs, deregulation, extending the tax cuts, maybe adding a few more, but they're not that much, as you said earlier. Um, the deals that are being done to bring foreign capital into the country, I don't have the current tally of the administrations, but I think it's over 11 or 12 trillion of at least verbal commitments from other countries and multinational corporations on big investments they're going to make here. Um, do you have any optimism that in the long run, if those get enacted, that they will eventually create, enough of a boost to economic growth that, yeah, maybe we'll have a recession on the way there, but we'll get to a better place? Or do you have less optimism?
I don't know how to evaluate those projects. I've read the details, and they potentially offer promise, but they're too vague for me to quantify them.
Yeah.
This I do know, and this is an important lesson of macroeconomics. The the uh, the trade deficit or the current account deficit or surplus, whichever the case may be, is the inverse of the capital account. So when a country runs a large current account deficit, such as we do, it means that people have to take our IOUs.
Mm-hmm.
And so we have a capital account surplus. And so funds from overseas are being invested in the United States. And as a result of the accumulated deficits, uh, the foreign sector, according to the latest numbers, has about 18.5 trillion invested in the stock market. It has about $4.5 trillion invested in corporate debt. So $23 trillion is in corporate paper. It has about 7.25 trillion invested in U.S. Treasuries, and it has about 2 trillion invested in agency paper. In other words, so if these programs are successful and they lower the trade deficit, they will simultaneously lower the capital account surplus.
All right. Meaning capital will drain from the U.S. financial markets.
Correct. And if you go back and if you look at the period of the 1920s and 30s when we had beggar thy neighbor policies, which were not only tariffs but depreciations of currencies when they were on a fixed exchange rate standard and other things, international trade came down and international capital flows came down. And so, um, so when you try to influence the trade sector, you adversely affect the capital account surplus. And right now, the people assume that that would be devastating for the treasury market, but they haven't looked at the data very closely. The foreign sector has 18.5 trillion invested in the stock market. It's up over 5 trillion just in the last year. And they have 7.25 trillion invested in treasuries. So you disturb the trade surplus, you're going to disturb the capital flows. So this year, simultaneously, what's happening is international trade is coming down and international capital flows are coming down. And I don't think that's helpful.
Okay. So, I mean, to a certain
Recession.
extent, it takes a bad situation and makes it worse, you
I
could say.
believe that it does.
Okay. All right. Let me ask you this. Before I ask my question, can you just take a second and explain to the audience why you look at money supply so closely, why it's so important?
Well, because I believe that there's basically a stable relationship between money balances and economic activity, and that when 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 the money supply after inflation and after adjusted for the trend rate of increase in money and velocity, which is a purely cyclical variable, if consumers experience a surge in money defined as I just did, then they will shed the money balances. And in so doing, they will bid up spending and eventually prices. And if money supply is below that trend, then they will have to build up their money balances. And to do so, they will have to um, reduce spending or reduce the prices that they're paying for goods and services. And so I believe that monetary policy is too restrictive to for the economy to continue moving forward with a 2.5% inflation rate and positive economic growth unless the Federal Reserve reverses itself. Now, a lot of people will say, Lacy, you've ignored the fact that money supply and bank deposits and bank loans got stronger since last November. Yes, they did. Now, normally, I believe that money supply is controlled by Federal Reserve actions, or sufficiently, not perfectly, or it's a function of the exogenous role of the Fed. But there are instances when the actions of the banking system and its customers can exert an endogenous influence, and that's what happened since November. When firms went out and individuals in business went out to buy things in advance of tariffs, they had to pay for it. And they didn't have sufficient cash balances to do so. So what did they do? They went into the banks and they drew on their lines of credit. And in the case of the consumer and small business, the lines of credit are very expensive. And so what we witnessed beginning in late November is a fairly significant uptick in both sides of the bank balance sheet, loans and deposits. But this buy in advance is now being reversed. And in the last 2 or 3 weeks, we've actually seen the other deposit liabilities in nominal dollars fall about $18 billion. Not a small change. It's over a relatively short period of 2 to 3 weeks. But I think it's part and parcel of this reversal of the buy in advance policy that went into effect. And so money supply is going to, the Fed is going to very quickly find out that it's much weaker than they think it is.
All right. So I didn't even have to ask my question. You did a great job of anticipating it and then providing the answer there. So just punchline there. Um, Money supply is important because in layman's terms, the more money sloshing around the system, the more people spend and the more economic activity happens. You have been ringing a bell for a couple of years now that money supply, as you measure it, which isn't just M2, but it also takes into account ODL, which are bank deposits, has been declining. And that I think has been a central argument of your case that you think deflationary trends are going to win out at the end of the day. Now, people recently may have said to you, Lacy, as you said, hey, that money supply is now increasing again. So, Lacy, looks like all your warnings were for naught. And what you're saying is no, that was just an aberration due to the front running. And now that that's over, not only has money supply started contracting again, but it's probably going to build momentum from here as we have a glut of inventory in the system. And a lot of players, including the Fed, may find themselves quickly surprised that the money supply situation is a lot worse than they're currently estimating.
You summarized it more succinctly and better than I did.
Oh,
And
not better.
you got it. I want to add just one thing. To me, the critical exogenous variable is my modernized version of world dollar liquidity, which is the Fed's holdings of government and agency securities and also foreign official holdings of treasuries. And it's the great leading indicator. Historically, world dollar liquidity grows at 10% per annum, and it's currently in negative territory. It's not as negative as it was at the worst point of the last couple of years, but it's still contracting, which tells me that this upturn that we saw during the front running period is going to be reversed.
Okay, so let me now kind of get to some rapid fire questions on the kind of so what? Like, okay, so what does all this mean, Lacy? So first and foremost, if you read the headlines right now, which is always a terrible way to invest, but if you're just reading the headlines, you're seeing, lots of renewed concerns about inflation, especially from tariffs. And I have the strong sense that A, you don't think that tariffs are necessarily going to be as inflationary as people think. Tariffs generally tend to anyways be a one-time price shock. They're not necessarily an inflationary pressure. And what I'm hearing from you is your focus is still fully locked on the deflationary forces that could draw things down here. So is it safe to summarize your point of view that folks that are getting wrapped around the axle on inflation are following a red herring and they should be much more focused on things like the contracting money supply?
Yes, and I also believe that except for the first round effects, the second, third, fourth, fifth round effects on tariffs are deflationary. So if you think of your demand and supply curves in microeconomics, when you impose tariffs, the upward sloping supply curve lifts itself up and shifts inward toward the origin.
Mm-hmm.
Well, as we know, the demand curve is downward sloping, so you're going to intersect at a higher price level. But the demand curve is upward sloping, so the quantity demanded is going to go down.
Right.
Now, and here is a little bit of economics that I hope people will check me out on, and they'll learn a little lesson that's quite valuable. Most of the goods in international trade are what we call price elastic. In other words, there are a lot of substitutes for them.
Mm-hmm.
Virtually the only thing that has an inelastic demand curve is energy and a few types of drugs that are very essential for maintaining life. But most of the other, when you have a price inelastic demand curve, it's a vertical line. So
Right.
if you impose a tariff here, the producer is able to push the price increase fully through.
Yep.
But the more substitutes, the supply curve gets flatter and flatter. The flatter the supply curve, the greater is the percentage decline in quantity demanded.
Per price increase. Right.
Yeah. So
Yep.
quantity demanded, the percent change is greater than the percent change in price.
Hmm.
Well, price times quantity, Adam, is total revenue for the producer.
Hmm.
So in that environment, the total revenue of the firm goes down.
Yep.
When the total revenue of the firm goes down, the demand for the factors of production go down. Now, the factors of production are natural resources, capital, and labor.
Labor. Yep.
So the price increase from the shift in tariff goes into effect, but quantity demanded goes down, total revenues go down, and so does demand for natural resources, labor, and capital. And so the second, third, fourth, and fifth rounds are deflationary.
Right.
And that
And,
was the case. That was the decay. The only way that would be different is if the Federal Reserve uh, at the same time jumped in and massively increased the money supply and allowed the price increases to be absorbed. But that's not what the Fed is doing. They're sitting tight.
okay. So on those third, fourth, fifth orders, the danger there too is you get into one of those vicious cycles, right? Where because companies are earning less, they then lay off more people, and then less people can afford to buy, and then therefore demand falls even further, right? That's what you try to avoid. So,
You know, the Fed likes to say that we are data dependent. We want to wait and see. In my opinion, there's no reason to be data dependent. In this environment, if the tariffs remain in effect, their ultimate impact is deflationary, not inflationary. And moreover, it comes at a time when money supply is also contracting. If you take M2, not ODL, and you put it on a 4-year moving average and you detrend for both money growth and velocity, you will, and we have to use annual data because we don't have monthly data in the earlier time period, and you start it in 1914, which was the first full year of operations for the Federal Reserve. What you'll discover is that we are in the ninth contraction since 1914.
okay.
Contraction number two was the one that led into the Great Depression. And all of the other contractions coincided with recessions. And real M2 on a detrended 4-year moving average is negative. And it's going to get more negative here as we go forward, in my opinion.
Okay. So you would say, okay, investors, you got to be focused on deflation. Don't get sidetracked by inflation. You would say you should have a plan in place should a recession arrive because you've given over 50% odds that one would arrive. I guess I should ask you, do you have any sort of timing expectation on that later this year? Or is it going to
I
be a
just, I,
2026 phenomenon?
my feeling is that if we're not in a recession now, we will be. It's kind of hard to have confidence when such a critical variable as payroll employment is so grotesquely uh, overstated relative to the business employment dynamics, which is your full sample of 12 million firms.
So this
It,
this is the BLS data that we're always railing about when.
yeah, and
Yeah.
keep in mind when you overstate the job gains, then wage and salary compensation is overstated, personal income is overstated, gross domestic income is overstated. And if there's less wage and salary income and personal income, then it enforces the notion that one of the reasons we see these constant downward revision in consumer spending is that is something called survivorship bias.
Hmm.
Let's say there's 4 firms in a field, and one of the firms fold. Well, at that point in time, the 3 remaining firms are going to pick up some of the fourth firm's business. And it could be in a declining overall environment. And a lot of retailers have gone out of business and a lot of others have retrenched. And so when you see a result coming out of the first quarter with this massive downward revision in real consumer spending, it's an indication that as you get more complete data and you minimize the survivorship bias, you get a truer picture. And so by focusing on things like payroll, employment, and GDP, um, you're working with theories that we don't really have confidence with, and one shouldn't have confidence with because of the fact that they're so frequently revised and generally downward.
So did I hear you correctly that, recessions are always declared retroactively? So if when the dust settles in the future, the recession was backdated to today, sounds like that wouldn't really surprise you.
No, it wouldn't because I mean we did get a very dramatic surge in vehicle sales there in the second half of March, and it continued in April. But the Ward's automotive data that I've seen for the first half of May shows a major reversal, and the consumer spending indicators that I look at in the early part of May, going through the first half to maybe the 20th of May, the consumer spending picture, other than automobiles, looks weaker. I think the consumer is currently retrenching, and I personally am concerned because that enhances my own worries about the restrictiveness of monetary policy.
Okay, so speaking of monetary policy, two questions for you. Uh, when do you think the Fed is likely going to act here? Obviously, we know it's going to be too late, or maybe what's it going to take for them to act? And then two, what do you think the Fed should be doing? If
My
you were running it
feeling
right
is,
now, what would you be
my
doing?
feeling is that it already warranted a cut, and I think that this year we'll see four cuts in the federal funds rate, 25 basis points cuts, even though the Fed funds futures market is only allowing for one or two. I don't keep track of what they're doing, but I think we're going to see uh, the federal funds rate be cut more often and by a total amount much more than the consensus is looking for. That has been my view. I know it's been an unpopular view, and it doesn't appear to be moving to fruition, but I'm not going to change it. I think the facts warrant that I stick with it.
All right. Basically, I take from that you're just saying the Fed's going to panic at some point this year.
I think whether should say they will panic, I think they're going to become concerned about the economic outlook. Yes.
Okay. All
And
right.
another thing too that I think the people need to be focused on, um, um, whenever you have a prolonged period of stability in markets and a lot of debt creation and perhaps risky debt creation, um, you there is a increasing risk of what people would call a Minsky moment. Now, a Minsky moment is very difficult to project. Um, but there are two studies that I would recommend people read that have just recently come out. One is from the Boston Fed on the systemic risk to the banking system from their lending to the private credit sector, and a similar study from the IMF, the International Monetary Fund, on this systemic risk that may link the banks to the private credit. Now, keep in mind the banks have right now virtually well, not virtually, but the entire increase in bank lending over the last year has been to one sector net, and that is to the non-depository financial institutions, which is your private credit. Now, these folks right now have good credit ratings, but they are lending to very risky borrowers, and they're leveraging those loans. And so the Boston Fed is saying there's a systemic risk. The IMF is saying there is a systemic risk. And there are a lot of instances in the past where we've seen similar types of behavior. And as Minsky said, stability leads to instability. Now,
Mhm.
you can't predict that, But this pattern of systemic risk is something that has me concerned about it. It's something that cannot be predicted, but it certainly, in my view, is in the system.
Okay. So, importantly, Lacy, can you send me the links to those two different studies? Would that
I'll
be
be
possible?
pleased to do that. Yeah,
All
yeah.
right, thank you. Please do that. And folks, what I'll do is I'll include those links in the write-up to this video that's going to go out to our Substack. And so that goes out to, to the free Substack so everybody can get it. So if you're not already subscribed to the Substack, folks, just go to, what is my Substack? Adamtaggart.substack.com or thoughtfulmoney.substack.com. Both will work. Sign up for the free Substack, and you'll get those links in the email that go out. That's the most efficient way, I
I'm
think, to get
talking
that to
about
everybody
something
else.
that's worth reading that I think you might be interested in. I don't know whether you've done it, but the world's greatest economic historian is Neil Ferguson. He wrote The Ascent of Money.
Mm-hmm.
It was a best-selling book. Economists
Yeah,
don't
I've
have.
tried to get Neil in the program unsuccessfully so far, but I agree with your assessment of him.
He also wrote a great paper, Empires on the Verge of Chaos. Um, and the editor of Noema recently interviewed Niall Ferguson, and I mean Neil, and it's really worth. It's Ferguson is such a intellectual uh, individual, and this interview is outstanding, and it deals on so many important issues. Some of them are totally unrelated to economics, but in essence, the whole thing is related to economics. And Ferguson believes that um, the American empire is in its later stages, which is a pretty bold prediction. But as he points out, that great empires typically don't last by more than 250 billion years. Now, that time counting is not the thing that he's relying on so much, but the characteristics in so many different areas of measurement are very similar to what has happened. And as he points out, um, the the U.S. has become a major global empire when many of the people in the United States don't want to play that role,
Mm-hmm.
and that's why we vacillate back and forth um, from one side of the equation. It's extremely interesting interview, and I'll send you the link to that. And um, I really encourage people to take the 15 minutes to go through the whole interview. It's an exceptional interview of an outstanding thinker.
All right. Well, look, I will, if you send me that link, Lacy, as well, I will include that in the write-up in the Substack. And folks, I don't need to tell you how smart Lacy is. You've already been clearly able to understand that through this conversation. I'm assuming almost everybody's going to want to watch somebody who you hold in such high esteem, Lacy. So thank you for putting that on our collective radars.
My pleasure.
All right, look, well, I'm beginning to look at the time here. I'm going to start jettisoning some questions, but I always have got some really key ones to ask you here as we begin to wrap things up. Um, so obviously, your outlook is not what many would call a very optimistic one right now, economically.
Some also call it unrealistic and badly late, and I'm certainly late here, but we'll see.
All right, well, from I think we have a sense of economically what you think is going to happen. What do you think is going to happen, as a result in the markets going forward as a result of all
Well,
this?
I don't want to go there. I just think that um, I,
Maybe even just generally like the market should do worse over time versus better.
I feel that there is great value in the long treasury market, and I know that I've given that prediction before, and it's not been right. But I think that there is a major. I mean, the bond yield here is very close to 5. It's been above 5 briefly in a couple of instances. Um, the Every time we go above 5, we don't stay above 5 very long. Um, The latest inflation measure is 2.5%, 2.4. Um, that includes the haywire measures of shelter, which are a huge component.
Hmm.
A lot of serious concern that it's overstated, excluding the shelter component. The inflation rate's only 1.5%. That's a huge differential between 5% and 1.5 or 2.5. And historically, those differentials between the bond yield and inflation have not lasted very long. And they've been opportunities, they've created opportunities for investors. And I think that that's one of the things that I can offer some opinion on. And I remain optimistic in spite of the fact that um, I have been overly optimistic.
Well, first off, a lot of people I think have been surprised with how sticky bond yields have been. So you're not certainly alone there. Um,
Doesn't
let,
make it any less painful for me.
I'm sure it doesn't. Let me ask you this. So for people who are watching who are saying, um, hey, Lacy, like you convinced me. There's a lot of reasons to be concerned. Maybe they even share some of Neil Ferguson's, more macro or meta level concerns. Um, and so they might think, well, gosh, wouldn't bond yields continue to march higher then as bond investors would demand compensation for this just higher systemic risk in the system? What would you say to them?
Well, historically, the taking on of debt is repressive through the law of diminishing return, the law of diminishing returns, and also because of the deadweight loss of the interest expense. What happens in some empires when they are debt overheavy, too much in interest expense, they do resort to money printing at the end, and the money printing then just makes things worse. Um, Money printing, people always say, well, we can always inflate our way out. No, we cannot. Um, uh, we tried heavy money printing during the pandemic,
Hmm.
and what happened? Inflation rate surged, and the tragedy of that inflationary surge during the pandemic and in 2021 and 2022 and early 2023 is that the burden fell most heavily on our modest and moderate income households.
Yep.
The majority of our people are heavily robbed by inflation. Virtually no one except the most wealthy of us. They don't have the resources to protect themselves, and so when you get into these highly over indebted situations, um, empires have tried to go the money printing route, and that occurs shortly before the violent end. But empires do not do well when they become extremely over indebted. Um, the great David Hume, who was one of the greatest minds of mankind, uh, probably the greatest economist of all time. Um, Even though he was much more than an economist, he knew everything about everything. According to Albert Einstein, he inspired his theory of relativity.
Oh, wow.
Um,
Don't get higher praise than that.
According to Einstein, and he discussed time and space in Treatise in Human Nature, written in 1756. He gave us the equation of exchange, money times velocity. He didn't write it down, but he gave it to us in verbal terms. And Hume also spotted the main error in The Wealth of Nations in a letter to Adam Smith shortly before Hume died in 1776. He pointed out that Smith had failed to take into consideration the utility of a good or quantity demanded. Smith thought that price was determined by labor input. It took the economics profession 120 years to correct the flaw in The Wealth of Nations. But Hume saw it. Smith read the letter. Hundreds of other people read the letter, but the profession didn't put it together for more than a century.
Hmm.
Um, and Hume said in his famous paper of federal credit, written in 1752, the same year, he wrote of foreign trade and of money, three tremendous papers, just as valid today as they were then. Um, he said when a government has barred all of its future revenue, the society lapses into tranquility, languor, and impotence.
Hmm.
Great David Hume. And he gave one other, and his policy recommendation for successful government was to always run budget surpluses so that when you have a national emergency, you don't have to go into debt to pay for it. And what have
Wow.
we done exactly the opposite? And
I
look
was
at
going
it.
to say,
Look at
yeah,
it.
that sounds like the exact opposite of what we have done.
Yes.
We and
By
pretty
the
much
way,
the entire
Smith
Midwest.
followed Hume in that too. It was, and Smith was mentored by Hume.
Um, Fascinating. Honestly, an idea just popped in my head. It'd be really fun to do a podcast with you at some point in time, Lacy. Just kind of hearing you do a layman's walk through economic history. I think that would be really fascinating. Folks, if that's something you're interested in, let me know in the comments section. If there's enough demand, I'll go back to Lacy and see if we can make it happen. So Lacy, I'm going to try
I
to
don't know
cram
whether I want to do that. Then I'll tell all my secrets.
Well, well, I tell you though, I mean, a huge reason, the central reason why I created this channel is the lack of financial literacy in our academic education here in America. And most people have not taken an economics course. And if they do, they probably remember nothing of it. And it was probably taught in a very dry, dusty way. You do a really good job of just boiling down the key gems and explaining them in a way that's intuitive for the average person to grasp. So,
By
folks, I
the
think we
way, by the
appreciate it.
way, if people are interested, and if you Google David Hume um, on money of public credit and on international trade, written in 1752, 1753, uh, although it's written in the English of the day, and that's a little bit of an obstacle, they're all worth reading because they're tremendous insights. And take
All
the
right.
time to do it if you want to build your library of knowledge.
All right. And I'm always having people ask me for books to read on these topics. So thank you for suggesting that as well. All right. So I'm going to try to cram in the last two questions before we end this, the last two main questions. First is, all right, Lacy, lots of issues here. We may be slouching towards that sad end that David Hume, thinks failing empires fall into. If we put the crown on your head and said, Lacy, you call the shots now, what reforms would you like to see most in the current system?
I'm in the investment management business, not the mind changing business. I don't want to go there.
Okay. All right. Um,
But I think I will say that it was a real tragedy when in the early 1980s, the House and the Senate took up Milton Friedman's amendment to the Constitution that would have required a balanced budget except when there's a 60% vote. In other words, that precluded budget deficits without exceptional support. I think the budget deficits have been a major problem and will become even greater problem because no one wants to deal with them.
right.
They're not
And
willing, and just as Hume said, they're not. I mean, we have a new bill here, a budget bill, which in my opinion really doesn't affect the deficit to GDP ratio, but it doesn't solve the debt overhang.
right.
I mean, as these bills go, it's not bad, but it's not what's needed.
Well, and not only does it not address the debt overhang, but it doesn't even address the deficit in general, meaning the debt will continue to get added just at
That's
the.
correct. Yeah.
So, and just to be clear for folks, so Milton Friedman basically proposed that rule. Um, it was taken up, but not passed ultimately.
It would be an amendment to the Constitution, and it required a two-thirds vote in the House and Senate. It got more than 50%, and in one of the houses, it came almost to two-thirds. There was bipartisan support then, and President Reagan was pushing for it at the same time, but it didn't make it through, and without passing the House and the Senate, it couldn't go on to the states for ratification. But that was a very important turning point, I think.
Well, not only just a turning point, in terms of the legacy it's left, but also, it really cemented in, the what we'll call the Mao incentive, I guess. Every politician has to spend today and let tomorrow be somebody else's problem.
Yeah, and that's what they do.
Yeah.
Kick the can down the road.
Okay. So last major question, and this deserves, and again, a whole.
There is, I would say that there is a small effort in the U.S. Senate to try to cut spending a little bit. And it won't be very much, but it would at least be a positive sign for everyone to latch on to. If they could just bend the deficit to GDP ratio downward a little bit, it it would really be an important sign, even if the movement is very small. We'll have to see whether they can do it. It'll be interesting to watch.
All right. Well, yeah, I don't know if I'm going to take the over on that, but I'll be rooting for it
I'm
along with
not
you,
sure I
Lacey.
would either.
All right. Well, last question, Lacey. And again, this is one we could do a whole nother interview on. So I'll just take your very high level thoughts. But you are a gentleman of a certain age. You've had a long and very successful career. You have been a student of the world. And from our previous conversations, I know that you study a lot of things, not just economics, but psychology, the mind. You've certainly watched the march of history, um, and we've met personally.
Yeah.
So I've gotten a little bit about
We've
your
become
life.
good friends, I would
We,
say.
we, we really have, and it's a huge honor of mine.
I'm
Um,
honored to know you as well, Adam.
well, thank you. And I
And it
think
was
we
a
both,
pleasure just to meet your wife, too. That was fun.
well, and that we just did that virtually and hope to do that in person sometime.
Yeah.
Um, But where I'm going with this is, look, this is a channel that's all about building wealth, and we spend a ton of time talking about money. But I
Mhm.
do like to pause every once in a while and remind people that money is a means to an end. It's not the end in and of itself. And um, you know, I try to encourage folks to really focus on investing in the things that truly matter in life. So as you look back over your life and the things that at your stage that you really value, like what makes a rich life in your opinion?
Well, um, I think what makes a rich life is that you try to um, provide a situation that makes the intellectual development of one's successors, their children or grandchildren or nieces and nephews, better off than you were. Because our future is really in the youngsters. And I think we really have two responsibilities here. Uh, we have to arouse in them intellectual curiosity, but we also have to try to inculcate in them important moral standards, um, the golden rule, do unto others. And you have to do both. And what what concerns me about what I'm seeing today is that we're failing on both of those counts.
Mm.
We may be making them more materially well off, but in terms of the foundational structure of overall well-being, our case may be undermined by our focus on the material. Anyway, that's a heavy answer for a heavy subject, Adam.
It's an
Give
authentic
you
answer
another
and
answer.
one that I think resonates with a lot of the folks here. I appreciate you being so honest on that. Um, well, look, my friend, you have I hope you feel this already, but you have left a great legacy for the next generation in the wisdom that you have shared over many, many years, of course, in your work as well. But in your latest incarnation as sort of one of the eminence grises of economics and coming on programs like this and really sharing your expertise, your perspective. So again, Lacy, just I can't
Yeah,
thank you enough for everything.
my pleasure.
All right, well, real quick as we wrap up here, folks, if you have enjoyed this conversation, obviously please let Lacy know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Lacy, I know you're a very self-assuming guy. You don't seek attention. If folks want to follow you and your work and your thoughts in
I
between now
know.
and the next event,
I can't do that because it's constituting advertising, and
okay.
so
So just
I'm
watch your videos online, basically.
yeah.
Okay. Well, I will let
Google,
folks know too.
You can Google my historical record. It's there.
Okay. I will remind folks too that you have keynoted I think every one of the Thoughtful Money online conferences so far, and will continue that fantastic track record in the fall.
I'm looking forward to it. I'm
Thank
looking
you. And
forward.
I don't think I've announced to folks yet what the date is. So folks, this is early heads up, but it's going to be on Saturday, October 18th this year. Lacy will kick it off as he always does. And for those that have watched, they know this is true. Lacy's graduate level keynotes, the chart parade that he brings, and just the river of data to the points that he's made here, that's worth the price of the conference in and of itself. And of course, you get like 9 extra hours on top of that. But that in itself
A
is worth
great
all of that.
conference.
It is a great conference, and actually this year we've had a lot of demand for folks to join the faculty. We've been super lucky. You'll be happy to hear that Judy Shelton has joined the conference, Lacy, as well as Jim Grant already. So we're already building a great
Well,
bench to follow you.
Jim Grant and I are decades, known each other for 4 or 5 decades, a long time.
Well, it's going to be just a super treat to have you both there at the same time. All right, well, folks, look, if you feel the weight of what Lacy has shared with us in terms of what he thinks is likely to happen from here, and you would like some professional help in figuring out how to navigate your financial assets through that, I highly recommend that the vast majority of people watching this get that from a good professional financial advisor. Very importantly, one who takes into account the macro issues that Lacy has laid out for us here. There's a lot of financial advisors out there, but a lot of them don't take that stuff into account. They're just in the kind of time in the market. Don't worry, just go along and cross your fingers and wait 20, 30 years. So if you've got a good advisor who meets those requirements I laid out, great, stick with them. If you don't, though, consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitment to work with them. It's just a service they offer. All right, Lacy, thank you so much. It's been a great discussion as always. I'd love
All
just
the
to
best
give
to
you.
you, Adam. Have a great summer.
All right, my friend. Lacy, it's always such a pleasure. Can't thank you enough. Everybody else, thanks so much for watching.